Good morning and welcome to the Markel 2025 Markel Omaha Brunch. So let's now do as we always do in this room and open it up to your questions. I recognize people have flights to catch, so people will be coming and going. We will try to answer as many of your questions as we possibly can. We do have a tradition of giving someone the privilege of asking the first question, and we're going to continue that particular tradition today. After that gentleman asks his questions, I would ask you to line up. I think we have 2 microphones. I can't see them. We're a little blind up here. And somebody's standing by one of those. Oh, there we go. There we go. Got it. So Mark Hughes, there you go, will be our first question here. Mark has been a long-term shareholder of Markel. After Mark, the people in line, if you would let us know your name, where you're from, and if you're a Markel shareholder, and perhaps how long that might have been the case. But with that, we start off the questions with Mr. Hughes.
Thank you.
Gotcha.
Thank you, Tom. What a perfect bookend to the weekend for all of us. Thank you for doing this. The presentation, fabulous. Of course, my question would be, what took you so long to do this? But now that you're here, it was terrific. Mike, thanks for keeping it simple. You knew the crowd. Before I ask my question, a young lady to my right here asked if you would mention a couple books that you've read in the past year that you thought of. So somewhere along the line, if you can slip that in, that'd be great. You mentioned early on in the presentation that the insurance operation wasn't living up to expectations in certain parts of it, not all of it, but there were parts that needed to be improved. And my question is for Simon, and my God, what took you so long to get here? I mean, what a fresh face, the energy, everything. You know, it just seems to be something that we needed here, and so thank you for attacking the problem. My question is, we're on the outside looking in. How are you going to be tracking the progress, whether it's qualitatively, quantitatively, and how, for us on the outside that have sensed that there was room for improvement here, what should we be looking at to see that what you're doing is working? It can't be just as simple as the combined ratios improving or revenues. If you were in our shoes, what would you be thinking about measuring how things are getting back to where we think they can be? Thank you very much.
Thank you, Simon. I think that's directed at you, and feel free to answer the book question along the way.
It was better than that than Mark, thanks so much for it was lovely speaking to you yesterday evening as well. And you know, actually, I would say with this meeting, the ability for us just to interact, not just in this space but other ones as well, that's fabulous. So it's been good to get to know you a little bit better. How are we going to look? How do we know if this is an improving business over time? The thing about an insurance organization, as you know, one of the issues you've got is like you write the business today and you don't actually know what the cost of goods sold are. You don't know what claims are going to be over a period of time. So the actuaries, to a great degree, are making estimates that sit it. So you only find out if you've done really well or not quite so well a few years into the distance. So there's a little bit around that where you won't see it instantaneously. I think that's important just to point out. So what will we look for? Firstly, I want some qualitative feedback as we go through. So we are going to start surveying our people in the business and the brokers that we deal with, asking them some pretty simple questions, some simple metrics, finding out whether or not we feel as though they're finding it easier to work for and deliver decision-making and to trade with Markel this year, right? So that'll just be a qualitative feel about, are we doing the right things? Are we attracting more business into the organization? Are people feeling good about it? The second thing you should look for is me beginning to describe the business in terms of these P&Ls that we're setting up. So we'll be very discreet about the areas of the business that we're tracking, we're measuring. And so when you go like, well, what's going well, what's not going quite so well, I expect to be able to start answering those questions with much more precision than you've had until this point in time. So I can demonstrate to you and our wider group as to what's going well, where are we going to need to start doing some work. And I think the final bit I would look for if I was sitting in this room is some degree of stability. What I don't want to see is like, oh, it's a good quarter, a poor quarter, a good quarter. It just feels as though we're sort of relentlessly moving to an improved result that you've got quite a lot of faith in. And I think you're going to see that as we go through this year, just like the steadiness of the improvement that you just feel. So it'll be a feel of just stability and the guys are in control. So those three things: qualitative, the ability for us to describe the business at that P&L level, and then finally just the stability and the steady improvement of the result. But maybe Brian, you might have a couple more comments on that.
Yeah, thanks, Simon. A few things. We've done a lot of work the last few years on the underwriting side. We've talked about that extensively. I think you'll start to see that slowly come through our first quarter results. You saw kind of that year over year kind of underlying combined ratio improvement from where we were first quarter of 2024, first quarter of 2025. So you're starting to see that come through. That really now becomes the springboard for us to grow. And as Simon mentioned earlier, we're really looking for all those areas across the globe where we can grow and we can grow profitably. So you're going to see a lot more of that in the messaging. As Simon said a minute ago, that won't show up immediately. You'll see it in the top line, the gross written premium first, then comes through the earned premium and the results slowly over time.
Great. Thank you.
Thank you.
Zone 2.
Hi, Tom. This is Ken. I'm from Taiwan. I've been a Markel Group shareholder since last year, and you've made me really good returns. Thank you.
Thank you.
And I just want to say that my friend, she said that it was the best investment she made. It's better than buying a Taylor Swift concert ticket. Thank you. Right. Oh, so my question is, as young investors like myself, do you recommend us to buy growth stocks more, or do you think buying dividend stocks and using dividends to reinvest is a better strategy? Thank you.
Thank you. Thank you for the question. I think some of the categorizations and groups that investment professionals put stocks in are not tools that I would use, and those are labels that I don't use. It's almost like labeling people. I don't like to do that because I like to understand the intrinsic quality and intrinsic value that each individual brings to a particular task. So as a younger investor, and frankly even one who might be criticized as not being quite so young, what I look for in a company is one that can take the capital they have and compound it and reinvest that thoughtfully over time, and earn good returns on that. And that can mean both reinvesting in the business that they're in. It can mean making acquisitions. It can mean buying in their own shares if they think they're of value. It can include dividends, but I really look to the intrinsic nature of the business itself as opposed to putting a label of growth or value or dividend or international or domestic or small or big. All of those are appropriate labels, but they don't tell me the truth of what it is that I'm looking for. So I'm just like you're looking for an individual that you think is going to be better, stronger, faster, learning, curious, adaptive over the course of the next 3 to 5, 10 years. That's really what you look for in a company as well. It's the same idea. So that's what I would do. Thank you. And one.
Hi, I'm Tom Nelson, a podcaster from Minnesota. In 2023, at the Berkshire meeting Mike, I asked Charlie Munger if he still thought Americans were, quote, really massively stupid for not taking untested mRNA COVID gene therapy. Charlie responded, yeah, sure. At the Markel meeting the next day, Tom, you were asked about your favorite parts of the Berkshire meeting, and you mentioned my question first, but you didn't say why that was your favorite. I'm asking you now, do you agree with Munger's take on that gene therapy? And do you think that those shots should have been mandatory, as Munger suggested, and if so, why?
Well, I'm going to confess, maybe this is where I'm showing my age. I don't remember that particular response. Now, I will say that I did have the vaccine, so maybe the vaccine caused my memory loss. I don't know. The third thing I'll say is you're way beyond my area of expertise, but I do like the fact that people ask Munger questions, and I do appreciate the nature of his answer, which was an answer, but I think it also implied some humility, because if someone says yes, sure, or no, sure, that's not a 100% answer. So the ambiguity that was involved in that, I think, reflects the complexity of things that were involved. So thank you for your question. Zone 2?
Hi, Tom. My name is Dawn. I'm a finance auditor from Singapore and an accidental Markel shareholder because last year when you came to
Either
Singapore...
way, we're glad you're here.
It's a great thing. So I'm actually that friend who bought one share just to attend Markel Singapore because I never thought I'll make it here. Thank you for having us and hosting us here. I want to ask your thoughts on a trend that's happening right now. So in Warren Buffett's 1982 letter, he expressed concerns regarding the potential loss of investing stewardship as well as the detachment from underlying business fundamentals that the rise of index investing and funds could bring. Given that this is currently the predominant theme, and in a lot of my investment teachings that I do, I realize that the common answer from many people is they just want a DCA into the S&P 500 and not do anything else. Less people are perhaps folks like us who are interested in finding the next 10x compounder and hold that forever. So my question is, what are your views on this rising theme, and do you see that that is going to increasingly lead to bigger valuation distortions and will make it harder for us to find these undervalued gems if they don't make it into the index funds?
Right. Well, thank you for the question. That's a great question, and thank you for traveling from Singapore to be here, and thank you for being an accidental Markel shareholder.
Just
As I
wish
said,
I bought
our
more.
doors are wide open. We'll take all kinds. I think it's fascinating that that question was addressed by Buffett in 1982. 82, that's what, 43 years ago? And frankly, he was, as often is the case for people who have such incredible foresight, he was ahead of the curve in discerning the possibility for exactly what you spoke of. Now, I like to always stay positive and never, as Buffett says, praise by specifics and criticize by category. So I'm going to indulge in a Buffett technique to do exactly that for a second. So again, it was 84 when I actually started in the investment business myself, and Buffett spoke specifically of his missteps in making investments in the airline industry and how that didn't work out. And I remember that and have made some of those mistakes myself along the way. Apparently, I need to learn lessons the hard way as opposed to studying and learning them from somebody else. But I used to joke, almost from the very early days, that if you really want to beat the S&P 500, what you should do is buy all 500 stocks and then not buy the airlines. So you would have the S&P 494 or whatever that was. And sort of by definition, I think you would outperform. And I think that's correct. So in terms of investing, if you think it is a contest with the indexes, that's a legitimate frame of mind that you would have. And I think you are correct in that so many people have adopted the practice of hitting the easy button or doing something that has worked spectacularly well, so you can't argue against it, for so long that perhaps we have lost the underlying sensation of thinking. Why is that true? And why or why not may it continue to be true or not in the future? So the valuation discrepancy that has happened among the upper tier of the S&P 500, they sell at pretty fancy prices in general. And it might well be that this era that we've been through of outperformance or really tough performance setting by the S&P might be very, very difficult for the S&P to keep up with. I'm not making a prediction, but just doing math and common sense, next 5, 10, 20 years, it may look very different than what it has in the last 5, 10, 20 years. And a friend of mine proposed a thought experiment where he says, imagine two different scenarios, scenario A or scenario B. Scenario A is one where the S&P 500 goes up, it's flat. It goes 0% for 10 years, just as a thought experiment. But you made 2%. So you beat the S&P 500 by 2% for 10 years. Pretty good result, right? Scenario B, say the S&P goes up by 12% a year for 10 years, but you only make 10. Now, as an individual investor trying to create wealth and fund your retirement, pay for college educations, things like that, which would you take, scenario A or scenario B? You would take B, because even though you underperformed, you compounded your capital at 10% a year for 10 years. That's real money. As an investment professional, the way incentive compensation is designed, you would be hugely tempted to take scenario A because you would have been paid on relative returns where you made 200 basis points as opposed to 0. But your client was not as well off. I think we have created the dynamics where those sort of forces are in play. So the idea of being thoughtful and specifically choosing companies which may or may not be in the index and may or may not be something that's going to win a comparison or not, I think there is epic value from doing that. And that's really what I spend my time doing with my investment hat, is to think about each individual business and the characteristics of each individual business, and can I count on them to relentlessly compound their capital, like what we're trying to do at Markel. And I try to think of that as independently to the S&P as I possibly can. Thank you.
Yeah, hi, my name is Ira Holtzman. I'm from Chicago, and I became a Markel shareholder 3 years ago after attending the brunch. I went and bought, and have continued to buy since. My question is, in reading the annual report, and you showed up on the screen about 9% compounded annual rate of return with regard to the stock price, yet you gave us your intrinsic value at, I believe it was about $2,600 a share, and obviously we're trading in the 1,800 range. Why do you think that there's that 30% discount to what the actual intrinsic value of the company is? Do you think it's part of your communication out to the general public? I'll leave that with you.
Thank you, and I'll invite Mike to speak to this as well. Yes, the communication challenge is one of the things we think that we're trying to address as we go through things. We think what we have some control over is doing the things that relentlessly build shareholder capital. And in acknowledgement of that math, A, we've made some fundamental changes in the business itself, and B, for the first time in the history of Markel, we have repurchased a meaningful number of our shares. And we think that is the best way, through our actions, we can indicate to the market that we think this is the highest and best use capital allocation choice that we can make right now. But
probably the only thing I'd add to that is a little bit of cautionary note about that tool, and you want to use a screwdriver for screws and a hammer for nails. The main point of that, as I said earlier, really overly simplified metric is to gain a sense of a rate of change as opposed to a dollar value. And over time, if the rate of change continues in that range that we want to see, our core belief is that eventually that works out fine for shareholders. And you may get periods of dislocation, and in either direction, by the way, but as long as the rate of change stays at a healthy pace, at some point it works out fine. So if you wanted to get to a real specific exacting dollar valuation for the shares, that's work that you all do day in and day out, and we have our versions of it. That would kind of be just a starting point in some sense, if that makes sense.
yeah, I think Mike's making a very good point there. It wasn't the specific point estimate that we hung our hat on. It was the idea that whatever method you choose, however you choose to go about it, if you do it consistently using the same method, you're going to get a rate of change. And that's what we were really trying to illustrate, and we put some numbers out there just because it helped people anchor on that. But the rate of change is what we're looking at. The rate of change probably has been diminished by the things that Simon spoke about, where we didn't execute as well in the insurance business as what we would have hoped we would, so we're working on that. B, communication. C, the last 5 years, and again, I've been in the investment business 40 years now, I'm going to suggest that was a pretty challenging 5 years, and there was some weirdness about it, given COVID, given everything that happened, that made some of the ending point, starting point comparisons a little tougher than they would normally be. As Mike alluded to in his comments, now that we're past the 5-year first quarter of COVID kind of stuff, we think those comparisons are starting to have a little more validity to them. And then the last thing I would say about that is, for instance, our incentive compensation is tied to 5-year rolling averages. And 5-year rolling averages, I think, are longer than most other companies would use to begin with. Secondly, the way we do that consistently year over year means they blend into one another. So, for instance, I've been there 35 years. We have this long-term horizon in sort of measuring and calculating things as anybody know. And as Buffett spoke about yesterday, he talked about CEOs keeping their shares. I don't have 100% of my net worth in Markel, but I have the vast majority of it in Markel, and that has been true for a long time. So we are in it together.
Tom, last point too that occurs to me, it's worth making is that is an important question that remains in front of us, a great question to ask, and we continue to study that. The board continues to study that, and as we said earlier, we're not going to accumulate a long list of ideas and then go wait and do them after the list is complete. As we're finding good ideas, we're taking immediate action, and we're still learning.
Zone 2.
Bel Air, Texas. Thanks for hosting us, Tom. I guess there were some issues in the construction lines. It sounds like you're going into some areas like, offshore wind construction, which seems like just more complex construction, then war risk in Suez. And I guess the genesis of the question is, how do you make sure you're pricing for risk properly? And also, workers' comp is generally doing pretty well right now for a lot of people. Over time, some people have gone into workers' comp, sometimes aggressively, and they get into trouble. How do you make sure that doesn't happen? And if you get in trouble in a line like, pollution, how do you make sure that doesn't stick with you for many, many years?
Right. Fair questions. Let me ask Simon to address that.
Yeah, I think every line of business I went up there it's risky, isn't it? I think that's the point that you're raising. So whatever we're doing, we're going to be taking risk on. So whichever line of business you will describe, you'll say, oh my goodness, do you really want to be writing that or not? Now, what I would say on the lines of business that we put up there, marine war, offshore wind, and the pollution coverage, which is our environmental products, we have been doing all of those areas for many, many years. Right? So it isn't just like let's go do that today. And in each of the areas, actually, we've made good money, very good money over the last few years as well. Why is that the case? Well, as I said in the presentation, the absolute critical aspect of this is to have expert leaders who spend their time, effort, and energy in those very areas that we're seeking to play. Where you really get burned in this industry, if you're a little bit novice and a little bit amateur, and you dip your toe in the water in some of these areas, there's got alligators, sort of in the waters, and you get your leg bitten off quite frequently. Yeah? So if you're going to do it, you have to be committed to it, and the commitment is building teams of people who really know what they're doing. Pricing is absolutely central to what we do, right? So the offshore wind farm, for example, the two things that play there is probably going to be something like a $3 or $4 billion risk. We're never, ever going to be writing a $3 or $4 billion risk. It doesn't make sense. So we're going to be putting a proportion of Markel capital in a syndicated way at a price point that we think will, you do enough of it, you're going to make money time and time again in that particular area of the market. You then go to environmental, you build another pricing model for North American pollution coverage that you're doing, and you're saying, this is what I'm prepared to underwrite and give you terms and conditions on. This is stuff that we're not prepared to do. And the people that know that best are absolute experts that are in that field. So the dedication to these teams of people is absolute. What you then start to see are claims start coming in. Either from, these things you tend to find out quite quickly. And what you need to be able to do is have a feedback loop from the claims that are coming in back to the pricing and the underwriting capability within the machine. So the tie-up between claims, underwriting, actuarial is really, really critical. And one point I would make that I didn't make earlier, I think within the US in particular, there was a little bit of a time where, because the structure wasn't right, we'd begun to go away from one another in terms of those key disciplines of claims, actuarial, underwriting, so the feedback loop wasn't as good as it should have been. So look, we're going to take risks in risky spaces. We'll minimize that risk first by not we're not going to bet the house in any one of these particular areas. But the most important thing that we do is dedicate ourselves to teams of experts who really know what they're doing, have a track record of doing it for a long period of time. I'd rather go deep in those things, and that anything where we think we're going to have a little dabble in it, as I've used that word before, we never ever go into dabbling type things. Final point on workers' comp, because you brought that up as well. there are some states in the United States which are very, very difficult workers' comp places. We know where they are, so we are aware of what those workers' comp problems are. We've been running a really profitable shop over there. We typically do the very small workers' comp is our typical thing there. We love that business. I do think we can go into the kind of the middle market a little bit more. So we're not going to go from tiny to massive all of a sudden, but just accelerating through into the middle market a little bit can definitely transform that, whatever it was, $450 million or so in workers' comp to something nearer to $1 billion. But I think we can do that with confidence as we take it forward. But Brian, maybe any comments?
Yeah, maybe I'll add two things to what Simon said. I agree with everything he said there, but let's take construction and workers' comp and take them as kind of polarizing examples. People that were writing the workers' comp back in 15, 16, 17, 18, and we've seen this within our book as well. We were not expecting the level of loss takedowns that were there. What happened was loss trends, medical inflation actually came down later in the tail than was expected, and we had a lot of releases of reserves across the entire industry. We benefited from that. Construction, the exact opposite happened there. When we priced that business back in 15, 16, 17, 18, the loss cost trends that were out there, that was not what the industry was expecting. Things like social inflation reared its ugly head years into the tail, and now you have adverse development going the other way. The point that I think we're making a little bit is around portfolio management. And so if you're really outweight in construction and underweight workers' comp, you kind of see the dynamic that happened where we had to take the hit here and a little bit of the gravy here. Others were a little more balanced, and that's a little bit of what we're working on in terms of the overall portfolio construction.
Thank you, and I'll just conclude. One of the other features that's built off the feedback loop that Simon mentioned is the fact that insurance is iterative. So we do our best to have the expertise and to understand what we're dealing with, but we also have the humility to know that we don't fully know. So we try to structure things in such a way that if we are wrong, we can still answer the bell for the next round of the fight. And in answering the bell for the next round of the fight, we incorporate the learning that we had from getting it wrong. And the ability to do these things over and over and over again is one of the ways in which that expertise is built and developed. Over here.
Hey, Tom. Excuse me. John Norwood from West Des Moines, Iowa. Traveling far away, but with my question actually was going to be the question you just addressed on risk, I think, around unusual lines of insurance and so forth. So thank you for addressing that. Thank you for your annual shareholders letters and the presentation today. I really appreciate that. My plan B question is capital allocation and new ideas. And give us a little bit of I guess, your thought process or the process for how that capital gets allocated across the spectrum of possibilities.
Absolutely, and thank you for the question. So there's really a sequential process that we would go through when we're making a capital allocation decision. First off is within the Markel Group itself, in our insurance businesses, and all the diamonds that Mike put up there, there's some people who are doing really well, and there's people who are not doing quite as well. Well, guess what? The people who are doing really well, if they raise their hands and say, hey, I have an idea to grow, those people are first in line, and they get funded first. So that's really the first choice of where we would put capital dollars, is to fund people who are already within the house, already within the structure, who have a positive idea. And I might add, and I would relate this to Mark Hughes' first question about Simon, and Andrew too, and Mike and Brian, that applies to people as well. So he asked, Simon, where were you? Well, the great news is Simon was inside the house, and he had done a great job, so it was easy to make, in essence, a capital allocation that we want you to do more of it. So that's step number one. Step number two, we can make acquisitions into other businesses. And oftentimes, especially as the size and scale of and the breadth of activities that Markel Group is doing, the inside expertise we would have about any particular business that would come across our radar screen is enhanced by all of the businesses that we're already in. And Charlie Munger talked about the lattice work of models. So we have, for 20 years, broadly, both insurance and non-insurance, and almost for 100 years, in the context of insurance itself, been continuing to develop that lattice work of models such that we have almost an instantaneous reaction that, hey, this is a good idea and worth learning and pursuing and figuring out, or this is not for us. So that is very helpful in that particular process. The third bucket is we can invest in publicly traded securities, and that can be fixed income or publicly traded equities. So we think about that. We've been a long-term buyer of public equities, which I think Mike or Andrew cited in their presentation. I think our unrealized capital gain right now is $8 billion. I think that might be the second biggest unrealized gain of any company in the country. Now, we're here in Omaha where the biggest one is, and we're not going to catch that anytime real soon. But number two, silver medal, that feels pretty good to me. So that's the third thing. And then the fourth thing is if our shares are undervalued, in our opinion, that also can be a place where we put capital. And while I listed them as 1, 2, 3, 4, they can all take place at the same time. And there are some years where we've done all four of those things. But those are the traps.
And what about international equity markets? How do you think about that?
Well, a couple of ways. One, many companies that happen to be domiciled in the U.S., including Markel, have substantial businesses outside the U.S. So if you went back 20 years ago, the percentage of Markel that was outside the U.S. would round to 0. And Brian, what would you guess it would round to now, 25?
Yeah, 25, maybe even a little higher.
Yeah, exactly. So a lot of U.S. companies have substantial global businesses, including Markel. So that gets you part of the way there. The second thing is, and I had the privilege of visiting our Singapore offices this year, first time I'd ever been to Singapore, and getting to know our people that are in other offices. I love doing that. I love listening to them. And if they tell me in their markets, these are people who are really running a good business, this is a really good business, I listen. So I think it will be the natural outflow of the fact that we have both insurance and industrial businesses doing more and more business all around the world, that we would become more learned and more sensitive and allocate capital that way as well. Thank you, John.
Hi, Tom. My name is Joey Opekin. I've been a shareholder since 2019. I'm based in Richmond, Virginia. My question is addressed to you, Tom, and Andrew. So similar to Mark's first question, what metrics from the outside should we look at to see the organic growth of the ventures companies unfeathered from new acquisitions, so the companies that we already own? How do we see them growing and relentlessly building and compounding our capital?
Great. Let me turn that over to Andrew for first response.
Thanks, Tom.
That didn't really land sincerely to me. You want to try that again?
I gotta clear my voice. I've been sitting here for a while, just enjoying listening to Simon. It's a delightful accent he has. Joey, great to see you again, man. Thanks for being out here. You're a wonderful friend of Markel, and I'll do my best to answer your question. You know, Mike and Tom both alluded to the process that our board is taking on right now in terms of a review. Mike talked a lot about simplicity, and in simplicity, I think one of the clicks down is into clearer communication. So Joey, you know, I'm blessed to have a lot of the data, right? I get to see it from our companies. I think we know that it's not as easy for you to see. Ultimately, I think if you take long-term trends on the overall Markel Ventures piece, that's one data point you do have today. And I'm going to go off memory here, so do my best. But if you look at the last 10 years and you read a bunch of footnotes and asterisks within Markel Ventures, you will see that about $1.6 billion of your capital has flowed into Markel Ventures. That would be contributions from the holding company, net of dividends back. That would be loans from insurance organizations, net of interest and repayments going back. And you will have seen that our operating income has grown from $80 million to over $520 million in that period. So that's not organic growth, but for $1.6 billion, taking $80 million to $520 million, I think is a pretty impressive record. But I will say, we continue to review our communication. We're super open-minded about what the best way for you guys to understand our business is, and we look forward to reporting back to you more on that this year.
And the good news, Joey, is that those businesses, whether they have a rapid growth year or not so rapid growth year, they tend to produce cash throughout the cycles. And that cash as part of what we've been able to use to fund Markel share repurchases at what we think are attractive prices. So the answer gets mixed between Markel Ventures and Markel Group. But rest assured, we're doing everything positive to build Markel Group as a whole that are the shares that you and I both own. Thank you.
Thank you.
Yes, my name is Brian Book. I've been an investor in Markel for over 10 years. So on behalf of myself and my family, I would like to thank you for all of your hard work and excellent results over that period of time.
Thank you.
Now, the purpose of my question is whether an individual, for me to determine whether an individual investor like myself should invest domestically or in foreign capital markets. The question that I have for you is not to agree or disagree with what I'm about to say, but to let me know if, in your honest opinion, I'm being fair to Charlie Munger and Daniel Kahneman. I try to stand on their shoulders whenever I can, and I know you do as well. The second part of my question is, I know you read a lot, and that's why I respect your wisdom. So if you have any books on this particular subject that you could recommend, I would appreciate that very much as well. Now, again, I'm Brian Book from the blue city of Dallas and the red state of Texas. One of the greatest thinkers of all time, Albert Einstein, said, "Problems of such division in the United States can only be solved by a higher level of consciousness than the level of consciousness that created those problems." So, in all humility, I don't know this higher level of consciousness that Einstein is talking about. However, following the wisdom of Charlie Munger, I'm going to always invert whenever I'm in a situation like that. So, recently I read a great book. It's called The Great Partnership by a philosopher from Cambridge and Oxford, Jonathan Sachs. And in that book, he says, science and a higher level of consciousness are compatible. He also says that a higher level of consciousness without science is blind. So, if I am correct in my analysis, and I'm not saying that I am, but if the GOP under Trump is attacking science, as Paul Krugman readily admits in his most recent Substack, should I be investing in the United States on a going forward basis?
Let me go ahead and try to.
Sure.
Let me start saying I don't know as quickly as I possibly can. So first off, I appreciate the question. On that disclaimer side, that slide that we had up, sometimes this past performance is no guarantee of future performance, and this is not meant to be investment advice. I add that to as a disclaimer language, so I really can't opine on the idea of domestic versus international. I would suggest, and we've seen this both in the case of Markel, Berkshire, so many companies, companies as they become bigger and more successful tend to become more global over time. So those things become a hybrid and they blend together. The only other thing I think I perhaps can add, Einstein's level of scientific abilities far surpass anything that probably the collective IQs of all of us in the room together could come up with. So if we're not that smart, what do we do? And I think you heard much of the answer of that in the presentation today. We, following the scientific method, take a big problem and try to break it into its components, piece by piece by piece. So the complexity that Simon addressed and the fact that we have perhaps gotten over complex. Well, Do we have an Einstein to work on it? Wish we did, but we're not. So what do? Break it down into smaller, more discrete pieces in order to tackle smaller problems that we can. Thank you, sir.
Good morning. I'm Michael Buckley from Fort Worth, Texas, and this is related to the Markel Ventures side. Wall Street doesn't like cyclical companies. And Tom, one time you mentioned that you bought cyclical companies at a 5 multiple, thinking that if it just survived at this pace for 5 years, you get your money back, but basically had an option on things improving. I think this was in response to the dredging company. So many years later, does the practice square with theory? And does it change the game that you don't intend to sell these companies and only care about the free cash flow generation? And has having Markel as an owner been able to improve these cyclical holdings, and how so?
Thank you. Thank you for the question. And you are correct. So for instance, compared to private equity and the way that they would look at a particular business and the fact that they would tend to use a fair amount of leverage typically to buy things means that they sort of need annual, if not quarterly or monthly cash flows in order to service the debt that they have. If we got to go head to head against a buyer like that who's willing to use all the tools of leverage, it is pretty unlikely that we're going to win a business or a bid, especially in an environment such as we've been in for the last several years, where they're getting funded pretty well. So it has been the case, and we have bought some Markel Ventures companies, which I am delighted with, where we recognized that, hey, you can't pick quarter by quarter or even year by year what the cash flows are going to be, but you can think about sort of 5-year buckets of time, which we think are very reasonable buckets to think of, and think if I lay out this much capital today, how much capital will I probably get back over the next 5 years? And we're willing to absorb the volatility, and in so doing, get paid better than we would if we were trying to compete against the tougher private equity buyers. So we've run that play successfully a number of times. And the bigger Markel Ventures gets, the more different businesses we have that are on slightly different micro trends. And in aggregate, what may start out, if we had only one thing with a lot of volatility, that volatility at the aggregate level gets smoothed down. So that's a good thing. And it produces cash, which is a really good thing. Now, the last part of your question about our long-term time horizon, a couple of points about that. One, I believe that long-term time horizon helps and supports the people who run the business. That couple of years ago in the annual report, I wrote about the dual time horizons that matter at Markel, and I made reference to it in my comments today. Forever and right now. You can talk about forever, but you cannot use it as an excuse to not pay attention to the details and the realities of what you need to deal with right now. But it has been my observation that in the shorter and shorter time horizons that seem to be out there in the world, sometimes people make the right short-term decision, but at the expense of the long-term. There's a saying, a good farmer farms for the next generation. So a good farmer protects the soil and doesn't necessarily optimize this year's crop because he's thinking about the next generation and how he protects the stewardship of the farm itself. And that really is the mentality of Markel. And last point I'll make, Andrew referred to it a little bit. In today's Wall Street Journal, there's an article by Jason Zweig talking about the momentous events that happened at Berkshire yesterday. And he talked about one of the two advantages of Berkshire that apply to us as well, and we've talked about. One is that we don't charge fees to the companies, so they get to run the business without the burden of management fees, which helps them, and I think it makes them feel better as well as financially perform better. And number two, the cash flows that Berkshire has used, like that as Markel, has come about internally. We've generated the cash we use to do these things. And compared to most money managers, and many of you are, if you get a hot hand, oftentimes people push cash at you and say, oh, great, go, 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 go. And that's probably coinciding with time that they shouldn't be doing that. You know, that hot hand gets cold. And if you have a cold hand, but you're thoughtful and disciplined, sometimes people pull money from you at the time when they most should be giving it to you. So the fact that our structure in and of itself generates cash flows that are independent of whether somebody wants to give us money or not. It means we're not at the whim of marketplace emotions. We're not at the whim of bankers. And we have steady cash flows that can promote, I think, steady long-term behavior. Yeah.
We on? There we go. Lobbing a quick story to illustrate, real life story, and this speaks to the question that was asked earlier about societally, is there a move towards less interest in actually understanding the fundamentals of businesses Tom was just talking about relative to kind of just investment type metrics. We were looking at one of these businesses that had some level of cyclicality to it, along the lines of what Tom was describing, and there's some accounting peculiarities that we wanted to make sure we understood. So we engaged a nationally recognized firm that does that type of work just to make sure we weren't missing something. You'll both remember this story. And we really had a singular question, and that was, hey, we think over the next 5 or so years, as Tom just described, our sense is this is roughly what the business should make, and as long as it's going to make that, we feel very happy with the amount that we're paying for the business. Just tell us if we're missing something here. And that firm, which I'm sure does this type of process hundreds and hundreds of times a year for other clients, had no ability to engage on that specific question. They kept coming back to us and saying things like, hey, we've looked at the backlog and the forecast, and over the next 180 days, here's kind of what we think the business should do. And we're not so sure they're going to hit their 180-day budget. And they'd slide that piece of paper back over the table, and we'd push it back and say, that's not the question. The question is, are our understanding or our assessment over the next 5 years reasonable? Did not compute, which tells me somewhere out there in the marketplace, there are a lot of people worried about what's the thing going to do over the next, I don't know, 180 days, 100 days, 10 days, whatever, and back to the point of not being an Einstein. So long as that remains true, that creates an immense competitive advantage for us, as Tom described.
Right.
Hi, everyone. I'm Maria Messerly. I'm a shareholder that holds your shares for some years now. I'm coming from Switzerland. So welcome to Simon. I'm glad you're here and join the group and the team. And I have some Swiss chocolate for you to hopefully propel your growth story and the vision you shared with us. And my question touches different subject. So Markel has been an impressive track record with nearly 8 billion in unrealized gains on equity portfolio, commendable by any standard. Since 2011, you've been a net buyer of equities, and Q1 appears consistent with that trend. We know that some smart people in the town did slightly opposite things. So with your liquid assets now making up roughly a third of total assets, how do you think about the right level of liquidity, especially weighing near-term insurance needs versus the opportunity to act on market dislocations and the rising uncertainty with the US economy is heading now? I would like to share your way of thinking, and has this framework evolved since the downturns we've seen in 2008 and 22? Thank you.
Well, thank you for the question, and thank you for coming again this year. It's wonderful to see you. I might call on Brian in a bit to confirm what I'm about to say. So in terms of fundamental structure of the liquidity that we would have, our insurance reserves, which are amounts that we expect to pay out in the form of claims and expenses of running the company, we match that against our fixed income assets so that we always have more than enough to cover what we think are the cash outflows that come about from our insurance business. Moving one step up to the holding company, for instance, and this is something that I wrote to our board about just recently, and I wrote to them about it because I liked it. We have one maturity next month of about $600 million, for which we already have the cash lined up. That is right there, and we will wire that money and that will be paid off. I think in 27 and 29, we have two maturities that are about $300 million, and you know we're in the billions of dollars of liquidity, so $300 million maturities in 2 and 4 years from now. The next one is sometime, I think, in 2034, and then we go into the 40s. So as a component of our thinking and making sure that we are conservative and always able to answer the bell for the next round of the fight, one of the things we've done pretty successfully is locked in what I believe to be low-cost, fixed-rate financing for decades. And we think that puts us on very good footing. And Brian, you have anything you want to add?
Yeah, maybe 2 things I'll say to add. Everything Tom said, perfectly right on track. The $600 million, that's our preferred securities is what he's referring to there. Those become redeemable here in June, so that there's been $600 million sitting on the balance sheet for some time related to those. The other point I would make, we're holding a fair amount in short-term investments, and those are short-term treasury-type instruments. We like the yield on those right now. Those are paying good yields. Those are securities that could be in other types of very, very safe. They could be in treasuries. They could be in cash. They could something like that matches the reserves. We're just happening to hold them in those short terms right now because we like the return that we're getting on them.
Right, and the bit that we're redeeming in June, that has a 6% coupon on it. So there's a negative carry on that financing right now. So we will eliminate that negative carry in tick, 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 30-ish days from where we are right now. Sir.
Hiya, Bonde, 3-year shareholder visiting from London. Thank you for the presentation. I just had a 2-part question for Simon, actually. So in regards to the strategy for implementing experts in the field, one, could you talk a bit about the execution of that? So basically the way I synthesize it in my mind is relative to other competitors, you're essentially trying to get better people than the other guy, essentially more experts in the field, if that makes sense. So if you could talk a bit about the execution of that. And then secondly, how does this differ to what you were doing before? Because as you mentioned, these are lines of business you've been in for many years. Like, why was it not the case that they were experts in the field, given basically the length of time that you've been in the business? If you could talk a bit about that.
Simon?
Question again? Hello? Yep, there we go. I compliment you on your accent, obviously. Thanks for being here. Thanks for traveling all the way over here to be with us. It's meaningful. So here's the thing. The expertise that we've developed over a period of time, that is in the building. It's not like I'm going to flick a switch tomorrow and suddenly the experts that we couldn't find are suddenly with us. I genuinely believe in 90% of instances, the people that we need on the field have been out there. I think the problem comes from the structural point, or the strategic point and the structural point. The strategic bit was we've got these experts there, but we hadn't just said, look, that is what we do. We kept looking for other things to make it a little bit more complicated, so it didn't become just a simplification of that is what it is, right? These experts, that's where we should be completely focusing our attention into building those types of teams. So what I'm really doing here is just like, hopefully the scales dropping from the eyes and saying, you know what the business was that made us really successful by having those experts in the field? That's the business. So we're going back to sort of a recognition of that's what it is. From an execution perspective, what we need to do is give those experts complete transparency and control of running the business that they are responsible for. And I think we've gotten away over the last 5 or so years from giving those experts the literal tools that they need to do. They've had an arm behind their back, sort of figuratively during that period of time. So this is not new. In fact, this is what we've done. When we've done this, we've been phenomenally successful within the marketplace, genuinely. We've got bigger. But I just want it, so bigger doesn't mean that you have to scale and create matrices and become more complex. You can be big and simple, and that's what I'm trying to drive. And I think that will create an unlock for the expertise which we already have in the building and we feel real good about.
Thank you. And while Simon appropriately complimented you on your accent, it was interesting. So you said the word differ, but it landed on an American ear as defer.
Oh.
And I would say both of those words are accurate. So to some degree, the fault is ours of deferring what we should have been doing for the last couple of years. And I'm sure we are making some mistakes right now. We're humans. But what I pledge to you is that we will be doing our very, very, very best to understand and admit when we're not doing it right and learn such that we can be doing it better. So we will not defer, but we will differ in acting more quickly. I recognize we're past noon, which is our normal historic cutoff time. I recognize we used some time for the presentation earlier, so we'll stick around for a few more minutes. I recognize people have flights to catch, so I understand if you need to do so, but we will just answer a couple of more questions and then dismiss things. So, over here.
Good afternoon, this is Ravish. I am from India and I'm a proud shareholder of Markel Group. Thank you for doing this meeting. I have a question specifically on Markel Ventures. So Andrew, would love to hear from you on your long-term strategy for Markel Ventures, and are there any specific sectors or businesses that you think are synergistic to your core insurance business? Are you most bullish on specific sectors? Would love to hear that. Thank you.
Andrew? Yeah.
Yeah, I appreciate that. You know, I've been here 13 years. We talk about that a lot in terms of, you know, should we proactively identify a sector and go run in the middle of it and see who we can find? Or really, should we listen to people like you and your great ideas as to where we should be? And more often than not, we've done the latter. And what we've tried to do is find people like Simon Wilson, people like Danny Zink, people like Ken Newsom, Tommy Clements, Hunter Lansing, and on and on and on. And form a partnership with them. And at the end of the day, they're the ones, much like Simon talked about in insurance, they're the experts in the business. So for us to sort of have a view on a sector and then a view on the players and then identify who is readily available and willing to transact is not the process that we've followed. But what I would say we look for every single time, and I think maybe it's more common in some sectors than others, is cultural alignment and values. I mean, for us, we can't do a good deal, form a good partnership with people who don't live and breathe something like the Markel style every single day. And, you know, a natural question earlier was about international equities. I think another question would be about what about international opportunities in Markel Ventures? You know, I hope to get there, but look, I grew up in Savannah, Georgia. I've lost a little bit of my accent, but if you give me a couple beers, I might start talking Southern again. And you know, we want to do business with people we can know and understand. And the beauty of the breadth of the Markel Group as it grows is we will know and understand more things and more people over time. So I couldn't point to a specific sector. We do ask ourselves every time, you know, is this a business that has the opportunity to be successful 20 years from now? Nobody has the right to. But if we stare at that and we feel uncomfortable, then it's not a business for us. So if you got some good ideas, let's catch up after this, and maybe you can channel us in the right direction. So thank you.
Thank you so much.
Thank you. And I might add, I was looking at the notes that I took during the Berkshire meeting yesterday. The first thing I wrote down was Buffett's phrase, turn every page. And boy, the applicability of that thought process is universal. And I am so glad to have a team that when I gloss over some pages or skim or read too fast, they appropriately check and balance me to turn every page and slow it down. But the second note I wrote was about investments, and he said, things don't come in orderly fashion. And the point he was trying to make is that the fortress balance sheet which Berkshire maintains, and we to our own abilities, and we can't have the balance sheet in the size that Berkshire does, but in our own way, speaking to the debt maturities that we talked about, the liquidity, the collateralization, all of those are designed to be able to be reactive when opportunities present themselves. And we don't know when they're coming. It's been our experience for 35 years as a public company that somehow or another they always seem to show up one way or another. Sir.
Hi, my name is Luis from Guadalajara, Mexico, second-year student in Northeastern University in Boston. So as an international student, I'm very interested in taking advantage of these types of opportunities from learning from the best. So thank you for hosting this event. So I guess my question is, you guys describing yourself as a global company, what's your outlook on a market, business market, or economy like the Mexican one, which is very connected to the US one? Thank you.
I am a short-term worrier and a long-term optimist. So the course of the world has been up and to the right, and I think communication and technology and the interweaving of the global system is something by which we all benefit. And we can screw that up from time to time and have challenges, but in the long run, I believe that's what's best for humanity, and we as humans will make that happen. Let's get to the last question or two.
Okay. Hi, my name is Pavan Sharma. I'm from Toronto, Canada, and just thank you very much for this very, very informative presentation and all the questions and answers. Really, really appreciate it. My question really relates to the culture and leadership slide that was put up front earlier. And just to give you some context behind the question, I used to be with one of the big four audit and consulting firms. And within that context, we acquired a small consulting firm. It was a very successful small consulting firm. We put in place our culture, brought in some of our leaders, put in some of our metrics, et cetera. And in the course of about 2 years, that small consulting firm, essentially all the people there are left. And the value of the acquisition really was not realized. And they were doing well, they're performing well, there was nothing wrong in terms of values or anything. It's just a different way of culture that was there. So my question really relates to, as you think about acquiring businesses, as you think about the cultural piece and leadership piece, there are some pieces that are very important, but other ones that require autonomous independence. How do you think about that? How do you really match those two up to really realize the value of the businesses that you are acquiring?
Right. Well, thank you for the question, and thank you for joining us. And I'll tell you one thing that happened probably 4 or 5 years into Markel Ventures. So our insurance group was having a management meeting for the insurance leadership. And I was there, and because Markel Ventures was becoming a thing, and we'd bought half a dozen companies by this point in time, there was some interest from the insurance business, just, hey, who are these, we call them cousins, that are now part of the family in these Markel Ventures businesses. So we did a bit where we had the CEOs of those businesses just tell their stories of their business and who they were and how they did things. And after that meeting was over, several people from the insurance business came up to me and said, Tom, how did you teach those people the Markel culture and the Markel style so quickly? And I said, I was like Columbus in America. I didn't make it, I bumped into it. You know, the culture was already there. So what we try to do is not in any way have the false sense that we can make somebody different than who they are. As the poet Maya Angelou said, when somebody tells you who they are, believe them. So our job is to find and discern to the best of our ability who somebody really is. And if they tell us, if they show us through their words, through their behaviors, through their systems, through their actions, that they overlap and fit with the culture that we have at Markel, we believe them. And similarly, just as important, and this is where Andrew is spectacularly helpful as a teammate, his spidey sense about discerning when perhaps somebody might present well, but not be who they really are. This is an incredibly valuable function of the team to be able to discern that. So we don't think we can change people. We do think we can identify people who really want what we have, and we think what we have is so distinctive and not commonly available that it really is attractive to certain people, and that's the way in which we would go about it.
Tom, can that?
Yeah.
Hello?
Start talking and
works. Maybe.
There we go.
All right, so I'll just add one example, and I'm risking being really wrong with Hunter Lansing sitting right here. But if you read the Markel style, right, there's a number of words. You'll hear phrases like disdain for bureaucracy, respect for authority, build the financial value of our company, commitment to our communities. Those are things that we would say. If you look at Metromont, precast concrete, they would say faith, honor, passion. If you look at Lansing, they would say respect, service, excellence. Yes, I got it right. Those have a feel to it, but we don't change the words on the wall. We don't tell Hunter Lansing that these need to be your values. He said it's respect, service, and excellence. Those are great values. What we care is that they live it every day. And so I think there's a big difference in the example you gave and what our world is like when we talk about finding common values. It's their values just lived to the fullest every day rather than projecting ours onto them.
Thank you.
Thank you.
Yes, ma'am. Last question.
Good morning. My name is Yun Yun. I'm from Singapore. Thank you, Markel, for hosting us today. I'm very interested to invest in Markel Group, so that's why I'm here. So thank you. My question is, due to a lot of market changes and dynamics and technology disruptions, and we have a lot of noises in the market right now, right? So how do we balance between simplicity and focus versus the risk of over-diversification in terms of management of your portfolio and your ability to recruit the right people to invest in the right business at the right value?
Well,
thank you.
Thank you, and thank you for making the trip, and thank you for coming. Appreciate the questions that all of you have asked. And I think one of the statements you made, I think you used the phrase, a little bit of noise in the markets right now. Well, you couldn't be more right about that. I think the nature of markets is that there always is noise, some more, some less. The system of Markel, which we talked about, the idea that our business generates cash internally from the array of businesses that we have, that really helps tamp down the noise. I would hope that you as individuals would have cash flows, whether it's from employment, from businesses that you have, that also are positive and ongoing, because then we both have the same advantage. And as long as we keep the long-term time frame, the path has been up and to the right of the valuation of things in a lot of markets all around the world. So as long as we have cash flowing in, we can get on that train, and whether we got on at stop A, stop B, stop C, stop D, it goes to the good destination at the end. And to the last part of your question about over-diversification, and this has happened at Markel, and it's one of the things that we manage every day, the good people and the good businesses that do well, we do more of that. And the things where we made mistakes and we were wrong, we learn, and we do less of that. And what that has the effect of doing is that over time, it concentrates more and more of the forces on the things that are going well and the people that are doing well, and less on the forces that are not additive. That will never be perfect, but that's why we go to work every day, to sift and to sort and to figure that out. With that, let me close. Let me thank you again for being here. Thank you for your support. We can't do it without you. I know it's early May, but if you want another dose of this with a little different flavor, our annual meeting is May 21st in Richmond, Virginia. It'll be at the University of Richmond. You can find details on the website. We would love to see any and all of you who would be able to join us in Richmond for our annual meeting as well. Thank you very much. Thank you.